The world of finance, a whirlwind of transactions and investments, thrives on trust. Yet this very system, built on good faith, is vulnerable to exploitation. Enter KYC and AML, two critical safeguards protecting the integrity of global finance. KYC, or Know Your Customer, is the cornerstone of financial security, demanding businesses verify the identities of their clients. This diligent process helps prevent fraud, money laundering, and other illicit activities. On the other hand, AML, Anti-Money Laundering, acts as a vigilant watchdog, detecting and deterring attempts to conceal the origins of illegally obtained funds. Together, KYC and AML form a formidable defense against financial crime, fostering a safer and more transparent financial landscape. In an age of increasingly sophisticated financial crime, knowing your customer is not just good practice, it's essential. KYC regulations mandate that financial institutions and other businesses verify the identity of their customers. This rigorous process involves collecting and verifying customer information, including government-issued IDs, proof of address, and other relevant documents. Think of it as a thorough background check, ensuring that individuals are who they claim to be. The importance of KYC cannot be overstated. By verifying customer identities, businesses can effectively mitigate the risk of fraud, money laundering, and terrorist financing. Imagine a scenario where a criminal attempts to open a bank account under a false identity to launder ill-gotten gains. Robust KYC procedures would immediately raise red flags, preventing the criminal from infiltrating the system. KYC acts as a gatekeeper, ensuring that only legitimate actors participate in the financial ecosystem. Money laundering, the process of disguising illegal funds as legitimate income, is a global scourge. Criminals seeking to cleanse their dirty money employ various tactics to inject it into the financial system, often through seemingly legitimate businesses. This is where AML, anti-money laundering, comes into play. AML encompasses a set of laws, regulations, and procedures designed to detect, prevent, and punish money laundering activities. Financial institutions and other obligated entities are on the front lines of the fight against money laundering. They are required to implement robust AML programs, which include customer due diligence, transaction monitoring, and suspicious activity reporting. Think of AML as a comprehensive security system, constantly scanning for unusual or suspicious financial behavior. Any activity that deviates from the norm triggers an investigation, ensuring that potential money laundering attempts are swiftly identified and reported to the relevant authorities. While often mentioned in the same breath, KYC and AML serve distinct but complementary roles in the fight against financial crime. KYC focuses on verifying the identity of customers, ensuring that businesses are dealing with legitimate individuals. AML, on the other hand, targets the illicit funds themselves, aiming to prevent criminals from integrating their ill-gotten gains into the financial system. Think of KYC as the foundation upon which AML is built. By establishing the true identity of customers, KYC provides the necessary context for AML procedures to effectively detect and deter money laundering. For example, if a customer, previously identified as low risk through KYC, suddenly starts engaging in large, complex transactions that deviate from their usual pattern, AML systems would flag this behavior as suspicious, prompting further investigation. In essence, KYC and AML work in tandem, creating a robust defense against financial crime. Section 5. The Money Laundering Labyrinth, a three-stage journey. Money laundering is not a simple act. It's a complex process often involving multiple stages to successfully conceal the origins of illegal funds. Criminals go to great lengths to make their dirty money appear clean, utilizing various methods to evade detection. The journey of money laundering typically unfolds in three stages: placement, layering, and integration. Placement, the first stage, involves introducing the illicit funds into the financial system. This could involve breaking down large sums of cash into smaller deposits, often below reporting thresholds, or using seemingly legitimate businesses, such as casinos or restaurants, to deposit the funds. Layering, the second stage, aims to further obscure the trail of the money through a series of complex transactions. This could involve transferring funds through multiple accounts, converting currencies, or purchasing and selling assets. The final stage, integration, is where the laundered money re-enters the legitimate economy, often disguised as profits from legitimate businesses or investments. Section 6, Danske Bank, a case study in AML failure. The Danske Bank scandal, one of the largest money laundering schemes in history, serves as a stark reminder of the devastating consequences of AML failures. Between 2007 and 2015, billions of dollars in suspicious funds flowed through the Estonian branch of Danske Bank, a seemingly reputable financial institution. The scandal exposed gaping holes in the bank's AML controls, allowing criminals to exploit the system for years. A lack of proper customer due diligence, inadequate transaction monitoring, and a culture of silence within the bank allowed the scheme to flourish. Whistleblowers who tried to raise concerns were ignored, and red flags were repeatedly missed or dismissed. The Danske Bank case highlights the critical importance of robust AML compliance, not just on paper, but in practice. It underscores the need for a strong compliance culture, where employees are empowered to speak up about suspicious activity without fear of retaliation. Section 7. The 5 Pillars of AML Compliance, a Fortress of Security. Combating money laundering requires a multifaceted approach. Enter the 5 Pillars of AML Compliance, a framework designed to provide a comprehensive defense against financial crime. These pillars, working in unison, create a robust system for identifying, mitigating, and reporting suspicious activity. The first pillar, a designated AML compliance officer, ensures that there is a dedicated individual responsible for overseeing and implementing the AML program. The second pillar, a comprehensive risk assessment, involves identifying and assessing the money laundering risks specific to the business. The third pillar, a tailored AML program, outlines the policies, procedures, and controls designed to mitigate the identified risks. The fourth pillar, ongoing training and awareness, ensures that employees are equipped to detect and report suspicious activity. The fifth and final pillar, independent audit and testing, provides an objective assessment of the AML program's effectiveness. Section 8. Structuring and smurfing, evading the AML net. Criminals, constantly seeking ways to circumvent AML controls, employ various tactics to conceal their illicit activities. Structuring and smurfing are two such methods used to evade detection by making suspicious transactions appear less conspicuous. Structuring, also known as smurfing, involves breaking down large sums of cash into smaller deposits, often below reporting thresholds, to avoid triggering AML alerts. Imagine a scenario where a criminal has $100,000 in illicit cash. Instead of depositing the entire amount at once, which would raise red flags, they structure the deposits by making multiple smaller deposits of $9,999 at different bank branches, or using different individuals, known as smurfs, to make the deposits on their behalf. Smurfing exploits the fact that financial institutions are required to report cash transactions above a certain threshold. By keeping the deposits below this threshold, criminals hope to slip under the radar of AML systems. Section 9. PEPs, Sanctions, and Tipping Off Navigating High-Risk Waters. The world of AML compliance is fraught with high-risk individuals and entities that require enhanced due diligence. PEPs, or politically exposed persons, are individuals who hold prominent public positions, both domestically and internationally, and are considered high risk due to their potential influence and access to public funds. Sanctions, on the other hand, are economic and financial restrictions imposed by governments or international organizations on individuals, entities, or countries involved in illicit activities. Dealing with PEPs and sanctioned entities requires heightened scrutiny. Financial institutions must implement enhanced due diligence measures to verify their identities, understand their source of wealth, and monitor their transactions for suspicious activity. Tipping off, the act of informing a customer that they are under investigation for money laundering, is strictly prohibited. Financial institutions must cooperate with law enforcement agencies and provide information upon request, but they cannot alert the customer to the investigation.